Thank you very much. Ian, ladies and gentlemen, thank you very much. It's a delight to be here. I'm surprised we don't have the music for first thing this morning, and also maybe the stash of plates to start breaking, get into the mood. But thank you. On a more serious note, it's a pleasure to be here. A lot of topical issues to be discussed. I'd love a lot of questions later on. The way that people look at markets varies. Some people look at valuations, others look at fundamentals, momentum. The way I tend to look at markets is from a top-down perspective. I tend to start from the geopolitical environment. What does that mean for the economies, regionally, inter-regions, cross-regions, and then move into markets and specifically the underlying asset classes with overweights, underweights, and preferences. So if we kick off in terms of looking at things on a geopolitical perspective, and with that, if I may ask one or two questions of yourselves. If we could please put on the first question, and it's related to President Trump. We'll be kicking off initially with President Trump in this Trumpian world environment. So if you could please vote, in terms of, in your view, will US President Trump will not face impeachment, will face impeachment but not removed from office, will be the first president to be removed from office, or he will resign like Nixon did in 1974? Will not face impeachment, or face impeachment and not be removed from office? Yes, I tend to believe that that is going to be the case. The grounds on impeachment are not as strong. However, with the House being lost to the Democrats, there's going to be an increased risk of that, and we will discuss that in a little bit more detail. The second question, if I may ask you again to vote, is a little bit more longer term. This is towards the 2020 election. A, Trump will not be in office for 2020. B, he will lose the 2020 elections. C, he will win for another 4-year term until 2024. Or D, don't know, too early in the morning to be discussing US politics. Will win. So 53%, over half of you believe that he will win the 2020 elections. Again, we'll be talking about that in terms of our view as well. And a third that he will lose the 2020. Very few of you believe that he will not be in the 2020 elections, correlated to the previous discussion in terms of no impeachment. So if we now talk a little bit about Trump and go back to 2016, it was just over 2 years ago, in the summer of 2016, when it actually hit me that Trump was going to win. Despite what people were saying, despite the journalists, the strategists, the views, he was going to win. And the reason why I felt back in the summer of 2016 that he was going to win is, number one, Hillary Clinton had not increased her underlying polls given what had been happening with Trump. Secondly, the broader environment which led into Brexit, which led into the AfD in Germany, was very much prevalent in the US as well. And third, more anecdotal evidence, that I was chatting to friends of mine and old US colleagues of mine who, well-educated, top-educated, working on the East or the West Coast, Republican, they were going to be voting for Trump, but they were not making a lot of noise about it. So it seemed as if there was a silent majority which was ashamed of saying that they were going to be voting for Trump. And when I challenged Mike, I won't mention the surname, I said, Mike, seriously, you're educated, you know what it's all about, you've worked in the UK, and now you're back in the US, fund manager. And he said, don't believe what they say, it's not true, he's a doer, he's going to make things work, he's going to turn things around. So clearly, I felt that that was going to be the deciding factor, and hence why Trump was going to be elected in 2016, as obviously it happened. Now, we're 2 years in that. There are a number of interesting books which have been coming out. The one I've got only about 50 pages left on Bob Woodward's book, which came out the other week. And the interesting thing about Trump and Twitter is that he sees this as his megaphone. When within the White House they're trying to contain him from using it, he says, guys, do not stop me from using this. I do not have any other means by which to speak to the people that I represent. So for him, the Twitter is the megaphone. The other interesting thing again from that book is that Trump himself sees himself as the Ernest Hemingway of 140 characters. So he thinks the way that he writes in Twitter is of literary quality. However, impeachment does not mean removal. And the House, of course, issued articles of impeachment against Johnson back in 1868, the first Johnson, and Clinton. The Senate did not, of course, agree to that. Very bipartisan, especially with Clinton. All the Democrat senators did not vote in favor. No US president has been removed from office. In fact, there's a fantastic book I'd highly recommend, The Master of the Senate, from Robert Caro. Robert Caro has focused his career on Lyndon Johnson. He's written 4 books so far. He's in the middle of writing the 5th. And this 3rd book of the series is an amazing story about how the Senate works and the mechanics of US policy. So Democrats, we've got the midterm elections, of course, Tuesday, November the 6th. Very high likelihood that the Democrats will win the House, just to make it clear that the Congress is made up of the House of Representatives and the Senate. The House both have elections. The House is changed every 2 years. The Senate changes every 6 years, but 1/3 of it changes every 2 years. So now we have 1/3 of the Senate and the full House. And in order for a president to be removed, however, they need a supermajority of 2/3 of the Senate. So 67 out of the 100 senators need to be voting in favor of that. And The Guardian has some very interesting infographics following the US midterms. On the right-hand side, I've taken that from the Guardian. It shows that there's one majority. Right now, the Republicans hold 51 seats, one majority. But there's a lot of hard work for the Democrats to maintain all the seats which are up for election. So it is not necessarily the case that the Democrats will also win the Senate. The House, yes, but not necessarily the Senate. So the chances of President Trump, in my view, are that he will not be removed in the next 2020, but before the 2020 elections. And in my view, if he is going to be removed, it will only be by loss of those elections. Which brings us to the key driver, in my view, in terms of the US politics. And it's the economy stupid. For those of you who remember, this was the phrase which Bill Clinton used in his 1992 campaign. He used it again and again and again to emphasize the point that it's all about the economy. And if we look at the US on the left and on the right, 2016 first quarter, 2018 first quarter, and you can see that in terms of the employment levels of growth, there was a lot of orange or flat to negative in the middle parts of the country, which have gradually started to disappear. So the employment growth over the last 2 years, 2016 to 2018, did benefit the areas where the most of the Trump supporters are. Also, in terms of the goods-producing industries, they have also increased significantly. So 8% in mining and logging in 2017, plus 7.5% in 2018, from down 12% in 2016. Just an example. Another interesting point is the county's contribution to national employment growth for the 6 years prior to 2016. And we can see where the orange is, it was either flat or negative. Again, very much impacted the decision for people to vote in favor of change, in favor of Trump. Those middle part of the US was not impacted by the globalization, by the post-crisis environment, which helped the rest of the country. Now, moving a little bit, let's zoom in a little bit more onto the politics of Trump and his broader support. I think we all know that, in general, who the key Trump supporters are. What is interesting about this particular table, I've taken this from Gallup. Gallup tends to focus historically over the past sort of presidencies on what the various approval ratings are by age, by region, by race, monthly income, education, and so forth. So just to give you an example as to how to read this, on the left-hand side, 40% of all adults approved Trump. Of those, 47% are male, 47% of the males and 35% of the females. So more males approve of Trump rather than females. And for example, in education, of those with high school or less, 41% diploma. Of those postgraduates, only 31%. What's interesting here is on the right-hand side, the column related to politics. And this is important for the risk of impeachment and then removal of office from the Senate. What we tend to find is that the conservative Republicans, let me turn it around, he's got a very high approval rating from their conservative Republicans, 88%. Republicans, 86%, liberal Republicans, 66, all the way down to the Liberal Democrats of 3%. So he's got a very strong backing from the Republican Party. They're in support of him. Which means that as long as he maintains that support, the risk of him being removed from office by the Senate is, again, negligible. Another important or interesting graph to show is historical presidential job approval. And going back to Truman, there have been 3 peaks and three troughs. The peaks, 87, 86, and 90, coincided with the wars, the Second World War, and of course the 2 Iraq wars under the senior and George W. Bush. And in the bottom, 25% for Bush, for W, and also Nixon during his not impeachment, when he decided to resign from office with the Watergate scandals. And Obama was just below 50% at the worst, and what we have here is Trump between 40 and 45. Not as low as Nixon, not as low as Bush. Focusing on the president's approval from their own party, on the left, I have 2 examples from the Republicans, W and Nixon. Both of them started losing significant support from within their own party, down to approximately 50% before a brief respite for W. Bush, and down to 50% across Nixon. On the right, the equivalent of Obama and Clinton from the Democrats. Very high rating, approximately 90% for both, with a slight trough for Obama during the 2 midterms. So in my view, we're going to be, and I agree with the majority of you, that we're going to be having Trump for president again for another 4 years in 2020, with one caveat, and that's the only one caveat I would have, and that's that the economy, the US economy, will continue to do well. I'm going to talk about the US economy in a second, and I don't think it'll be sort of rallying at the same levels of growth, which are unsustainable, but economy will be strong. Again, from his core base, Trump has delivered. He's basically been doing what he said he was going to do. He's been dealing and disrupting the Washington consensus and the liberal elites. He's got a broad support base of the Republicans, which we mentioned earlier, but that's only one side of the coin. The other side of the coin is who's going to go against him? The Democrats don't seem to have a candidate which can bring together the party. Warren, Elizabeth, people have issues with her. Maybe not as strong as Hillary Clinton, but she's not liked very much. Bernie, far too left-wing for the majority of people. Maybe potentially he would also be considered as too old for that time. Bloomberg and Diamond, impossible. Again, they may get the voting from the East and the West. It's very unlikely that anyone between those 2 regions is going to vote for them. And the issue with the issue with the Democrats versus the Republicans, which is a political quote used, which is Republicans fall in line, Democrats fall in love. So Republicans, voters will vote what the Republicans put in as a candidate. They'll just fall in line and vote for them. The Democrats don't. The Democrats want to fall in love with a candidate. And if you recall, generally the world fell in love with Obama. The world fell in love with Bill Clinton and his sort of saxophone playing before the whole Lewinsky event. And that's what the Democrats want. We don't have that yet. And it's interesting to see if anyone comes to fulfill that role, whether it's Joe Biden, whether he's missed an opportunity. But clearly, I think that's a concern for the Democrats and one of the reasons why in my view, President Trump will continue to be in place. What impact does that have? From G7 to G0. Unfortunately, I don't remember who mentioned that it's a G7 to G0, but it's not a G6, because there is no G6 without the US, it's G0. He's basically put aside all of that. From people I've been talking to who are very close to the European, to the EU establishment, the EU politicians were shocked at the lack of multilateralism that he believed in. They were shocked by that. And even the last quote, even the quote from last week when he was at his second UN General Assembly, he said, "We reject the ideology of globalism and we embrace the doctrine of patriotism." So the US is standing aside, being slightly isolated, dealing with its own issues. What does that mean for the rest of the world? Well, the rest of the world is not going to stand still, and they have not been standing still. China and Russia have been getting closer together. China and Japan have also been putting the recent animosities surrounding the islands aside, and they've been to cooperate. For Abe, it's very important for him to get involved in this One Belt, One Road or Belt and Road initiative, see potential growth in the Japanese economy. Merkel has been on the front foot, with the EU and Merkel in particular, Germany and China in terms of the relations. The issues with Russia are a little bit more difficult. And one reason, just hands up, that every single picture I've put in my presentation has a reason and has a meaning, political meaning. However, there's a picture here of Donald Tusk on the left-hand side. The only reason I put that picture in is because a lady tweeted this picture, said, "I've never seen anyone who's basically eating an ice cream and being angry at the same time." And I thought that was very funny. And I thought, just for that, I'm going to put it in. And it's so true. There's no other political significance for having Daniel Tusk here. Moving more seriously again, my concern a few years ago, and during the whole Eurozone crisis, we can talk about that later on, was Merkel. Merkel was the Bismarck of today, keeping everything together via realpolitik way, keeping the EU together, keeping Germany together. And my concern was, as and when she departs, who's going to be taking on that role? Macron was not up to it. The UK was leaving. Who was going to be taking on this leadership role of taking the EU through the difficult times and then potentially to its next level? And in her fourth presidency, or chancellorship, she's basically focusing on internal issues. The AfD is created because of the break between the CSU. CDU, CSU are not that great. SPD has disappeared, similar to the Liberals here. So what's happening here? And I think what she realized, and this is again an impact from the US, Trump, is that in this current environment, the EU needs to be strong. And she therefore felt that in order for her, when she's sort of leaving, for someone to succeed her, would need to be the president of the EC, so the European Commission president, to be German. That had not been mentioned before. And now she's basically in favor of putting Manfred Weber, the head of the EPP party, to replace Juncker next year. So we're going to have a change of EC president next year with Manfred Weber very likely to succeed Juncker, and have a German as the head of EC president. That'll be the second time that they take that place in line with France. So I think this is going to be a change. Also, surrounding him will also be some very senior German civil servants. So that's the impact that I think Merkel is going to be having. As she's departing, she will want to make sure that there's a German consensus moving and holding on to the EC. That has a surprising impact on the ECB, because up until recently, the person who we expected to take over Draghi was, of course, Weidmann, Jens Weidmann. He was the guy who's going to be taking on the ECB. But it's very unlikely, it's practically impossible for Germany to get both posts, the EC presidency and the ECB presidency. So as a result, I don't no longer believe that Weidmann is going to be taking on that role, but I also don't believe that any French or Dutch candidates are going to be taking that role. They've already done it. So in my view, it's very likely we're going to have a Finnish in the ECB, a Finn. Liikanen in the middle I think is most likely to, or Olli Rehn on the right-hand side. And they tick two boxes. One, they're relative hawks. And the second, so that ticks again the one box. The second, that they're from a smaller country. So again, balancing from the larger to the smaller countries. So the change in the underlying political environment will also have an impact in terms of the ECB. And in the UK, obviously, we're on a standby. The economy has been on a standby the last couple of years. I believe we're going to be in a standby for another couple of years. A lot of internal politicking, which we've been very much prevalent of. We've been seeing that, inefficiencies in terms of productivity. The big question mark, Labour. Where's Corbyn? What has been going on internally within that? There's a huge opportunity being missed there in terms of the discussion, in terms of the debate. And that, I think, is something which we may be seeing and hearing a little bit more of. So broader, therefore, geopolitics, continuation of the Trump environment and the way that he's been dealing is going to be bilateral rather than multilateral. A lot of uncertainty from the geopolitical impact. What does that mean for the economics? Kicking off with the US, not much to say. The US economy is strong, will continue to strengthen. I don't believe it's going to be strengthening at the sort of levels of 4.3 or 4.2% growth rates. I think it'll come down to sort of 3.5, but still very strong. Unemployment levels, which are due tomorrow, expected to continue to do very well. Amazing unemployment levels, sub 4%. And inflation at target of 2%. We're going to be talking a little bit more about inflation because I think there's a risk there. But for the time being, low inflation, low unemployment, and strong growth. As far as the EU is concerned, again, we've been coming through the crisis, stability coming through. There has been some political instability recently. No, I wouldn't say political instability, some noise with Italy. Spreads have been widening. That will continue. That's going to be part and parcel of the EU project. Some political populism instability coming in from the peripherals, but also from the eastern countries, especially if we're seeing Trump aligning, or the US aligning with Poland, for example, versus the Polish-EU axis. On the left-hand side, the contribution to real GDP growth, the focus I'll just highlight is the red, which is net exports. A cheap currency, a cheap euro, will help the European economy. So I think that's important. And secondly, the excessive current account surplus, which Germany and China have very well documented. Fiscal stimulus we would expect to take place, partly to help the economy grow further, but also to deal with the current account surpluses. The other issue which the EU has is the NPL, non-performing loans or non-performing exposures. It was approximately 1.2 just after the crisis. That has been gradually coming down, approximately 800 billion euros. A significant portion of that is in Italy, Spain, and Ireland, as we can see by the middle bars, the light blues. However, and the small ones, the dark blue, represents Greece, Cyprus, for example, which may not have a large size of NPLs, but it is quite significant in terms of their ratios or overall loans. So the Greek economy, the Greek banks are trying to deal with that. The Italians have done very well in terms of packaging NPL loans and selling them off as a new asset class, looking to attract slightly more higher yield. The Greeks are behind the curve, but moving a little bit towards that. China, very topical again. I believe, and this is quite interesting when I discuss that with friends and colleagues, I believe that China would win from a trade war against the US. And the reason I believe, or what would I say win? I don't mean win in terms of the economy will not be impacted. The economy will be impacted. But I believe that China has, first of all, a much more medium to longer term time horizon. They can see through Trump. Even if Trump is 2 years or 6 years, they can see through that. They've got a much more longer-term horizon. And if, under the Trump presidency, let's say it's 6 years, another 6 years, the pendulum moves too much to the right, it will then balance itself and move furthermore to the left. So I believe that China will see through that in the same way that Netanyahu saw through Obama at the time. The two were the most adversaries on the political side. But Netanyahu saw through Obama. And with Trump, we can see the impact that has had. In the same way, I think that China can look through the US political environment. It will impact the economy, but it is a planned economy. They can redirect. They've been making some changes on the shadow banking. They could increase some of that leveraging. And President Xi does not have a time limit. And he can also contain or control the rhetoric or the narrative in order to maintain social cohesion. So for that reason, I believe that China could win from a soft power, the war against the US, the trade war. And if we look at the US, its overall trade to GDP ratio is approximately 15% versus China and, could we just move that slide back, if I may? I pressed the button by mistake. Thank you. So we've got US and China, but what's interesting is that South Korea, Mexico, and Canada have a much higher reliance on trade. And that's why when Trump was looking at the bilateral trades, breaking down NAFTA or versus Korea, these are easier targets for him to focus on. In terms of economy, the UK, as I mentioned earlier, it's on standby. I think we will be on standby again. I believe we're going to have a medium Brexit rather than the sort of hard or soft variety. It's going to involve a compromise. I do not believe we're going to have a no Brexit, even if the deadline looms the 29th of March. I think it would be most likely moved rather than dealt with a no Brexit. Under a no Brexit scenario, it's not just the UK which would be losing out, as we can see here on the left-hand side, but Ireland and Holland and Denmark would be also impacted. So I don't believe we're going to be seeing that environment. Again, a concern here in terms of the UK, in terms of sterling, would be the risk of a Corbyn government, the uncertainty that would prevail, but also the political and the divisive potential nature of a Boris Johnson challenging Prime Minister May at this stage. So a lot of uncertainty to come through and the economy on standby. In terms of the surprise for 2019 economically, I don't think it's going to be the trade wars or the trade frictions. I think it could be inflation. And the reason I say that is because from 2014 to the mid of 2016, there are two indicators. One is the five-year forward rate, and we've seen the sort of expected rate of inflation decline over that period of time, and since the middle of 16 pick up. In the UK, a little bit stronger because of the impact of the weaker currency following Brexit. And I think that will have a further upward trajectory. On the right-hand side, this is the market implied probability of higher inflation, in this case over 3% over the next 5 years. And it's 20% for the US and 5% for the EU. So the market is not expecting inflation at all. And it wouldn't need to have a lot of an impact for this to turn and create some uncertainty and volatility. Where from? Well, the economies are growing. We've seen the impact of the commodity prices coming through. I believe there's going to be further fiscal stimulus, generally, in order to contain populism and rebalance a little bit of the economies which we've had and the issues between generations since the financial crisis. So I think we are going to see a risk of inflation coming through. Quantitative tightening is also coming. We're all very much aware of the overall balance sheets across the central banks. This will take time to come through. I think the Fed will raise rates once more this year, a further 3 times next year, in order to contain any inflationary pressures which come through. The Bank of England to tighten, especially as the UK tends to be an inflationary prone economy, and a weaker currency does fuel inflationary pressures. The ECB under Liikanen, most likely next year, will start tightening. The BOJ, not yet, for a little bit more further down the road. US yield curve. There's a lot of passion on this US yield curve, predicting the next recession. There is basically what this is if the US yield curve inverts, the 2 years becomes higher than the 10 years, then historically it has been a predictor of a recession. So for example, if we look at this period here, it led to a recession, or here, or here. So the minute the inversion takes place, after about a year and a half, a recession tends to happen in the US. Now, some people believe this is the best predictor, put aside all economists. Others believe that there's no statistical significance in this. There's hardly any number of points to draw any real statistical significance. Whereas others, again, say this time is different because of the quantitative easing. Well, in my view, if there's an inversion, which means that the 2 years is going to go above the 10 years, it's going to be putting a stop towards the economy. It will create a slowdown. And I would expect that to start taking place early next year, with an eventual recession potentially coming in 2021. Not 2020, because I think from a political point of view, Trump would try to ensure that other measures are put in place so that they do not have a slowdown in the US just ahead of the November 2020 elections. So in terms of markets, what does that mean for markets? And in my view, volatility is the most important variable, because not only it impacts which asset classes one would be investing in, whether it's sort of a carry versus growth versus fundamentals, momentum, but also the uncertainty which impacts markets on a day-to-day basis. And I think we're all aware by the excessive sort of liquidity and lack of uncertainty which took place led to the gearing before the pre-election, before the previous crisis, and we are very much at similar levels of volatility. I think that volatility is mispriced, and if we look at the VIX as an indicator of volatility, the S&P VIX from the CBOE, I got that quote on the top. Unfortunately, I didn't source it. It was from The Economist, and I think it was The Economist, that 2017 had more days under 10% volatility than the whole VIX during its 28-year period. So a lot of low volatility taking place. I think we expect that to rise. Central banks, obviously, are going to start containing and draining liquidity. 2, the policymakers will start making policy mistakes, either tightening too fast or not tightening fast enough. Market participants will be mispricing or misreading those remarks. we have geopolitical turmoil and the potential impact of inflation. So in my view, volatility is going to be elevated and remain elevated over the next few years. Financial conditions, similarly, only one way to go, which is up. Excessively low. We saw the impact, of course, of the financial crisis, and since then, the quantitative easing, but I expect financial conditions indices also to tighten. Equity valuations are expensive. This goes back to 1881, the cyclically adjusted CAPE from Schiller and Yale. And where we are today is obviously a little bit higher than the previous peaks. It's not as high as 2000. I am not suggesting that this will immediately reverse. No, not at all, because it is very much based on strong underlying corporate earnings, predominantly from the US. So there is some support on the back of that. As and when the underlying support is not there, the corporate earnings, the strength of the US economy, then clearly those would be overvalued levels. But for now, it'd be very difficult. I would not be able to call whether it's going to be a correction today, sort of next year, or the year after that. But we are in overvalued and excessive territory. Major stocks to continue follow the US on the back of those earnings. Clearly the US has outperformed. DAX will also be impacted very much by trade. The FTSE will be impacted by the broader energy discussions. It will also be impacted by the impact of sterling. And Japan, again, from the quantitative easing and the weaker currency. Also what we're seeing is average correlations with the S&P have been coming off, and we would expect generally correlations to reduce across asset classes, but also within asset classes as volatility starts to rise. US bonds, in my view, will remain a safe haven. And I did mention that I expect inflation to rise. Obviously, this will take a little bit of time to come through. So for now, the 2.75, 3.25% is where I would say fair value for the US 10 years would be. We can move, of course, higher as inflation surprises take place. And this graph goes back to 1871, again from Yale. And we can see, apart from the 1970s inflationary crisis, it used to be between 2 and 6%. I don't think we'll be reaching 6% in this cycle. The central banks are very much ahead of the curve and aware, but we could be seeing up to sort of a 4% level of growth, of yield. But generally, if we see volatility pick up, correction stock markets, US bonds will be supported. And I found it interesting when Ian put his first question out, quite a high proportion of you thought that US bond yields would be attractive, and I'd agree with that as a safe haven. US high yield, unattractive and overvalued. Again, US high yield does not do badly when the Fed is raising rates because it's got the carry. It does do badly when recessions hit, but we're not calling a recession. I think recession again, 2021. But these are overvalued and unattractive levels. And in fact, for those of you who saw the FT and the second on the companies and markets, it's in the front page, the story about high yields today. Very low spreads, excessively low, similar to previous pre-financial crisis, and any signs of uncertainty will help to widen that. Emerging markets, under pressure. I don't believe there's a contagion, a broader contagion of emerging markets. It's more sporadic, idiosyncratic impacts, but I think that's likely to continue. With a stronger dollar, higher volatility, more global uncertainty, I think emerging markets are going to be taking the impact of that. And we've seen a lot of issuance which has come in, a lot of investments which have been coming into both emerging markets and high yield products. So, broader inflation issues, US economy to continue to do well, UK on standby, EU strengthening, albeit at a slightly lower pace, given the Eurozone crisis, given the non-performing loans, and China potentially to win, in my view, a war, should it happen, a trade war with the US. And last, I thought just to share some views in terms of the FX, some FX views that come on the conclusion of that. Well, the USD, this is the trade-weighted index. I believe that the US dollar is going to be strengthening over the near to medium term. What does that mean? It sort of means over the next sort of year and a half, year to year and a half. The reason for that, higher interest rates. So it's going to be a positive yielding currency versus the majors as the Fed tightens, but also safe haven. If we do see volatility coming through and emerging markets continue to have a difficult time, the US dollar acts as a safe haven. So that's the positive on the US dollar, but it is also credit trade. This is not a contrarian view. So it may take longer for the US dollar to appreciate, but I do believe it will continue to do so. Longer term, however, this easy fiscal policy, the tax adjustments, the pushing on the accelerator for growth at this point in the US economy is going to create some underlying fundamental issues for the US economy, twin deficits. And that will have a significant negative impact on the US dollar in the next periods, in the sort of medium to longer term. And that's where I would see a correction on the dollar, when the economies are focusing on the US imbalances. The euro, on the back of that, I'd expect the euro to weaken. When we did that, it was 117 just last on the 24th of September. It's 114 today. Again, I expect the euro to continue weakening lower, possibly down to the 105s. I don't think it's going to test parity, but we are going to be, I think, retesting the lows. And that's partly because no change in the ECB for another year. No interest rate differential bias from that. The EU economy will not be surprising on the upside. And with the recent political developments in Italy, we may have a little bit of uncertainty coming through. Sterling, if we look at sterling versus the dollar, I think that follows euro-dollar unless there is a no Brexit. So cable will be following the euro-dollar lower as that takes place. In terms of euro-sterling, this is the Brexit play. Our view is that after everything has been sort of said and done, there will be a compromise and we'll be avoiding the worst-case scenario. And as a result, sterling will be able to benefit versus the euro on the back of that. The renminbi. I'm sure you all remember under the Obama regime and Hank Paulson basically calling them the currency manipulators and all these guys weakening the currency. But we should not forget two things. Back in the crisis, the Southeast Asian crisis, the Chinese held their currency steady. They did not let the currency weaken like all the other regional currencies did, ex-Hong Kong dollar. But also in the financial crisis in 2007, 2008, they held the currency steady. And since then, the currency has been appreciating. From a trade perspective, China has been balancing its position very much. And more recently, we've seen a weakness on the back of the political unrest and the Chinese trade, US trade wars. I think the Chinese renminbi will continue to weaken. I think that the policymakers there will be using it as a negotiating tool. They have not used that yet. And if they do, it'll be a very gradual and slow approach. But I would expect for further weakness in the Chinese renminbi to take place. My favorite contrarian view is on the yen. People believe that the yen is going to be strengthening. On the back of the improving Japanese economy, my view is the opposite. I think that the dollar yen will be appreciating significantly further from here. I think that the weaker yen helps the Nikkei, helps domestic consumer sentiment, helps inflationary pressures to sort of start moving higher. And it's in the interest of the Japanese policymakers and Abenomics to ensure that that takes place. So in my view, the dollar-yen will continue to strengthen, and it is not a crowded trade. The only caveat here is that the yen is also considered as a way to risk manage a portfolio. So in periods of uncertainty, if you want to manage the beta risk of your portfolio, buying the yen, buying the Swiss franc, buying some VIX volatility would address some of those issues. So the yen could be used as a way to mitigate risk and manage risk as a portfolio play. And finally, just two emerging market currencies. The Turkish lira is one. We wrote quite a negative report back in the early summer on Turkey from an economic and political perspective. We expected a continuing weakness in the currency, and even from here, I think that currency is going to continue weakening. The economy is in a very difficult position, given the underlying political motivations, and I do not see an easy solution. Both solutions, whether it's dealing with orthodox policies or delaying it further, will have a continuing negative impact on the currency. So we'll still maintain our concern on the Turkish lira, but on the other hand, on the Chilean peso, I like the Chilean peso. The Chilean peso, in fact, Chile has the third longest border against another country. It's about 5,500 kilometers with Argentina. So there were concerns that Chile will be impacted by Argentinian correction, or by the fact that it's exporting copper and involved in mining with a potential slowdown in China. Well, in Argentina, it's got only a 2.9% trade, and with China, my view is that China is not going to slow down significantly because of the measures I mentioned earlier, the fact that it's a planned economy. So I think that the Chilean peso is undervalued, and last but not least, the new political administration with Finance Minister Larraín is very astute. He wants to contain the underlying imbalances and win back the credit rating which the country lost. So I like the Chilean peso. So as a conclusion, therefore, In terms of the geopolitics, I think that President Trump will be with us for another 6 years. I think that China will most likely win if it had a trade war because of the planned economy. Xi does not have a near-term target, a target time, and they can see through the US presidential election period. And we see a medium Brexit with a compromise with the EU. In terms of the economics, the US economy will continue its upward trajectory, albeit not at these sort of levels of growth. We expect the underlying sort of fundamentals to be positive, but creating some inflationary pressures. And the emerging market, developed market growth to be positive, with China at just above 6% levels of growth. Markets, market volatility is one. We expect market volatility to rise. We expect inflationary pressures to come through, global growth, fiscal policies, commodities impacting it. We've seen the price of oil. And as a result, we also expect some pickup in uncertainty. With that, we do see private markets to continue finding some attractions, as well as the listed markets, even though private debt may see some levels of excessive interest and excessive liquidity coming through. And FX, US dollar to remain strong over the medium term, so clearly through 2019, to correct later as the underlying US economic imbalances start to have an adverse impact on that. So thank you very much, and I'd be very delighted to take any questions on any of these related topics.
Okay, thank you. A round of applause, please. Thank you.